CNBC TV 18 and India Bonds presents Bond Street.
Hello and welcome to Bond Street, presented by CNBC TV 18 and India Bonds. India's journey towards the vision of Viksit Bharat demands a robust and diversified financial ecosystem, one that can mobilize long-term capital and at scale. A deeper, more efficient bond market will be central to that transition. Expanding market access, improving liquidity and strengthening investor participation is the goal. The Indian bond market has undergone a significant transformation, evolving from a largely institutional market to one that is gradually opening up to retail investors. With regulatory changes, shifting interest rate cycles and renewed policy focus after the Union budget and the Reserve Bank's latest monetary policy, fixed income seems to be coming back into focus. So, how should investors assess opportunities and risks in India's bond markets? To discuss this and more, I'm joined by an eminent panel of bond experts. Kaustubh Gupta, the CIO Fixed Income at Aditya Birla Sun Life. Amit Tripathi is the Chief Investment Officer Fixed Income at Nippon India Mutual Fund, and Rajeev Radhakrishnan, the CIO Fixed Income at SBI Mutual Fund. So that's the top fund houses represented here. Gentlemen, thank you very much indeed for your time. The focus of the show is also to tell our viewers how important the bond market is. So let me start over there, Kaustubh. Have you seen the evolution of the bond market since you first joined? I assume you've been a couple of decades in the market.
Yeah, it's almost that point. Look, when we started, markets were largely OTC. They were 100% owned by institutional investors. Information flow was heterogeneous and asymmetric. Yes. Each credit deals beyond government bonds were different. They were happening at a different rate. And the technological support was patchy in the sense that there was technological support, but the settlements were delayed, and at times they were not as easy as we have now. Now from there, of course, from a systemic perspective, we have moved a large way. Today, instead of only OTC markets, there are three options which are available to investors. One is OTC, second is OBP, or you can say the online
platform.
And third one is capital markets. So now investors, instead of one market which is OTC, now they have three ways to access markets. Each individuals or each investors, they have different access. From a technological support, we have seen a sea change. Yes. Now the settlements are seamless in the sense that with a click of button, just like equity, you can buy bonds. Information flows has also become a lot more homogeneous now. Any bond issues which come to the markets, the information is pre-uploaded, and investors who really want to do it, they can read the information, they can get the covenants, they can get the rates, and they can bid online. And which is why we are seeing now there is a little bit of gradual movement from institutional dominated market to some bit of retail investors now putting their foot inside that they also be part of this deal.
That's good to hear. A similar question to Amit. I started covering fixed income, which is like 3 decades ago. Every year we have this, bond market has come of age kind of feeling. What are the latest developments that you think make you feel that we have evolved?
Okay, so I would highlight just two very different. One, essentially an outcome of regulatory push, which has been the evaluation of corporate bond repo. I think we have been talking perennially about the illiquidity in secondary markets for corporate bonds. We have had a slow but a good start to the corporate bond repo platform. To our mind, I think this is going to be very, very fundamental in terms of generating liquidity for people to hold, buy and sell corporate bonds, and essentially should act in the long run as a very big catalyst for secondary market liquidity. The second and the third point I would say is transparency. I think the more we move to one way or the other to some kind of a screen-based system, it started with RBI through CCIL, SEBI through EBP. Now almost 99% of the bond placements that are happening in the market are happening through the EBP ecosystem.
The electronic bond platform.
Yeah, electronic bond platform. Even some amount of dealing is now shifting to the platforms now. OBPP is another phenomena which has come in. See, there was an OTC market which was very, very opaque to start with. The more you make the markets transparent, automatically I think investors get drawn towards that transparency because investors feel that they are seeing the true value being reflected as far as the screens are concerned.
Rajeev, I wanted to ask you, this online bond platforms, are they encouraging both debt mutual funds and corporate bonds? How do you see that evolving? Is it a big push?
Yeah, I think the way it has evolved, what clearly the advantage is that it makes access much easier, right? And more so for a retail investor. And regulations have also evolved to make it a little bit more tight-bound and very transparent. So I think that will still evolve. This is something that has possibly happened over the last couple of years. So when we go back, just to answer the question posed to my colleagues earlier, I mean, for me, there are I would say three significant changes. So one clearly is in market infrastructure over the last, say, 20 odd years. I mean, starting with NDS, then moving on to corporate bonds with EBP, RFQ. Amit mentioned about the corporate bond repo. Very little, it's not really got the attention that it should have deserved, because that's a very fundamental reform. I think the traction it's picking up. So market infrastructure, settlement mechanisms, a significant change from where we started. The second is probably regulation. Regulations have really evolved over a period of time. I can speak from mutual funds, and all of us are clearly aware to the extent that the regulations have really become very tight, much more of disclosure of what we do, what of portfolios. And the last part is transparency. So trade transparency, like 15 or 20 years back, unless you are in the market, in the OTC market, you possibly would not know where a certain bond has traded, possibly including G-SECs. But with NDS, everyone knows where the G-SEC is trading. And now with bond platforms, with the reporting platforms of both the exchanges, every corporate bond at the end of the day, you know where it has traded. So that is a significant amount of, I think transparency is a word here. So
you put your finger on it.
That's clearly what, and I think the bond platforms to that extent, I think regulation will clearly evolve even further. But yes, it's made access for the retail investor very much more seamless and much more easier.
Now, Kaustubh, the tussle for bond market, both mutual fund and the corporate issuer, is how do you access the retailer when the tax is against you? Small investors, even pensioners, tend to think that, oh, I'm still being taxed more. That becomes an issue.
Yes.
As a very big fund house, how do you all tackle this problem? That you have to invest as per your risk appetite and not for taxes.
Yeah, so look, the part questions are answered. You have already given that when these investors comes to us for the advice, we give them that you have to invest from an asset allocation perspective rather than asset class perspective only. Look, our understanding is that for any investors, the choice of instruments of investment should be left to him basis his risk appetite, basis his investment horizon, basis the macro conditions that he is assessing, rather than being through various carrot and sticks, pushing him through a particular asset class. And which is why it is very, very necessary that from an investment allocation perspective, you look fixed income also as a consistent cash flow throwing asset class. More so, today, especially post the inflation targeting framework, now investors have real yields in their account, which is so unlike maybe prior to 2013 when long-term real yield in India was absolutely negligible. Today, in last 15 years, I would say that real yields are now moving in the range of 1 to 3% from time to time. So from a real yield perspective, fixed income has come out very, very lucrative to these set of investors. Then there is a third way to understand things. As economy grows, it's for sure that the nominal growth will inch lower. Today, when nominal growth is at 10%, and if you are getting an annualized sovereign yield between 7.5 to 8%, it's a reasonable compensation. So the point is that when these set of investors come to us, we make them understand, aware of these things, the advantage that the fixed income bring to the entire bouquet of his investment portfolios, and we push them that you think it from a long-term allocation perspective rather than short-term benefit perspective.
Absolutely. I wish we could have you all oftener on the channel to explain that. But Rajeev, while that is how investors ought to think, that I may be getting only 8% or 7%, but if you take away inflation, I still get a plus 1% because inflation is now down to 4%. That's not how people think. I remember my father going to the UTI MIP because it gave 15%. He forgot at that time inflation was also double digits. You know, people don't think like that. It was at 15% that was attractive. And now our generation, my generation, on the, you know, to retire anytime, still thinks that, "Arey, ye to 7% hi hai." How do you teach people that real interest rate, that lesson doesn't register that easily?
No, it's a challenge, honestly. And this is something that is, I mean, over the last few years, and even when you look forward, you clearly have visibility on real returns, right? Given that inflation has stabilized at a much lower range than what we've been used to. But I think from an investor perspective, end of the day, post-tax returns do matter, right? There's a lot of allocation, and that's something that it's very difficult to change that behavior, because if you have an asset class that is giving you visibility of real returns on a prospective basis, but when you take it on a then I think post-tax, it clearly becomes a challenge. So I think that is an issue that we need to sort of live with, given that that's the policy framework that you have today. So from an investor angle, the appeal today lies in clearly you need diversification in portfolios. This is a cash flow based on income generating asset, which is giving you real returns. Now, post-tax return, it's clearly not something that you can really influence. So I think that's a message that we sort of reinforce that.
To come to you, Amit, you know, the other thing that confuses, and this is a confusion even with actually equity mutual funds, but even with debt mutual funds, the range, you know, from overnight, liquid, long, short maturity, medium to long, and then these are all duration, and then you have credit risk. Is communication an issue? I mean, how do you all tackle it?
No, communication is definitely an issue, especially in a scenario where you have many Me Too products within the same category. If you actually go back and look at how fixed income mutual funds have evolved, there are essentially only 4 categories, and if you put credit, there would be a 5th category, which is liquid and short duration, short to moderate duration, long duration. These are only 4 categories, so to say, right? And there were nomenclatures that were very well known. Earlier, you had only liquid, low duration, short term fund, gilt fund, right? Income fund maybe, and credit fund. So I don't think investors should really get into the jargon in terms of the language at all. In fact, the simplest way that we always reach out to investors in terms of explaining the funds is not necessarily in terms of what the fund does, but what should be the investor's time horizon for that fund. That's much simpler to understand, right? The fund will do what it is supposed to do in order to generate, in order to ensure that there is no negative experience for the investor over that tenor, right? So when I go to an investor and suggest a long bond product to him, it is not about the fact that long bond is at 7% or 7.5% or 6.5%. It is about that if you stay in this fund for 3 to 5 years, you will go away as a satisfied investor. You would have got the return for the risk that you have sought in this fund. And that's the simplest way to understand it. And I think investors should just divide their fixed income allocation into these 3 or 4 silos. What is very, very short-term requirements that you can call anytime. Forget everything else, just put it in liquid funds, right? What is the money that you don't want to put at risk, any kind of risk, but you don't really know the end use and when it will come, just go and put in a plain vanilla short-term bond fund, right? You can't hurt yourself at all, even if you stay there for 10 years. Just to give you some numbers, I think the last 15-20-year returns in short-term bond funds as a category would be between 7.5 to 8%.
Oh, really?
Okay? So you really don't have to think too much.
You know, you guys fill me with a lot of optimism that both in terms of legislation and structure, in terms of, you know, online, easy to use availability, and in terms of conceptual clarity, the industry is at least ready, and hopefully the buyer is almost ready to understand this, and maybe the debt funds will be able to give equity funds a run for their money. But we have to run into a break. We are back with more questions on what is the interest rate seen now after the budget, the US trade deal, and the monetary policy. Back in a minute.
CNBC TV 18 and India Bonds present Bond Street. CNBC TV 18 and India Bonds present Bond Street.
Welcome back to Bond Street, presented by CNBC TV 18 and India Bonds. We are still in conversation with the country's top fixed income fund managers, Kaustubh Gupta, the CIO of Fixed Income at Aditya Birla Sun Life, Amit Tripathi, Chief Investment Officer Fixed Income at Nippon Mutual Fund, and Rajeev Radhakrishnan, CIO Fixed Income at SBI Mutual Fund. Gentlemen, thank you very much for your patience. Let me now come to the here and the now. After the budget, you have this massive borrowing program.
Yes.
What is the way investors should look at it? Should they be worried? Is this not a right time for, debt investments?
I would say they need to be cautiously optimistic. Optimistic because if you look within the large economies, India is the only country, especially post-COVID, who is on the path of fiscal consolidation. And our inflation is much controlled compared to most of the peers, especially large economies, than what we want it to be. So from fundamental perspective, macro perspective, India's story is intact. The fixed income story is intact. There is no question to it. What probably market is reeling as of now is demand-supply mismatch. Last year, if you take into the net supply, of the total net supply that the central government want to borrow, reasonable large amount, about 60% has been taken away by RBI OMO. But still, the yield curves, they have refused to budge down. So clearly, the demand is not as strong as what probably the borrower, which is in this case government, thinks that there is a large demand. On top of it, because of variety of regulatory changes, the long-only funds, their appetite for incremental duration or incremental higher average maturity is much lower. Just to give you a perspective, prior to COVID, average central government borrowing program, average maturity was used to be about 14-15 years. Today it is 20 years. State government, which used to be 10 years, now it is about 16 years. So clearly there is a clear shift in terms of large supply in terms of average maturity. So I think some bit of more active support, both in terms of more OMOs, or you can say this supply duration modulation needs to be done so as to communicate market that these rates are too high to be comfortable with. And if we really want to be set path on fiscal consolidation, we need lower rates, especially on the long end side of it.
Rajeev, there have been two or three new initiatives, right? SEBI's Pan-India Bond Outreach program was there. Niti Aayog put out a paper on corporate bond market. Are you seeing these as, paving the way for more appetite?
There were a few measures that came in the budget
also
with respect to new products. So yes, it improves the existing market. When you go back to the first question, that the market infrastructure. So in this case, you're introducing new products. Would it really incentivize demand? I have my doubts.
Okay.
It makes the existing market ecosystem better because you have better tools to hedge your risk. But does it really bring in new demand? That's clearly not addressed. So it is part of the ongoing market development efforts, so to speak. But I think that needs to be supplemented by demand incentivization measures. Otherwise, you don't necessarily get a very deep, vibrant liquid market. Okay. So I think that's my...
I take your point. It's made the existing market sophisticated. Would you agree, Amit?
Yeah, I think what the fixed income markets have lacked, unlike the equity markets in the last 20 years, is development in terms of sophistication, right? Even today, you don't have any viable alternatives in terms of hedging, either for credit risk or for duration risk in a measurable manner, apart from only one instrument that is used by the entire market, and it has its pros and cons, so to say. So I guess whatever has been done in the last 3-4 years, including what has been recently announced, are all ways in terms of possibly making the markets more efficient, more transparent, better in terms of functionality, etc.
Okay, I'm coming to my pet question. Where are we headed in terms of yields? First to you, 6.7, after the borrowing program got announced, actually the yield went up on the 10-year from 6.65 to 6.7, went to 7.5. What do you think till March and for the rest of 2026? I think
broadly, in run-up to the March, I think yields are likely to remain stable, and they are more driven by what's happening on the global front. At least in our view, globally, the policy fabric is turning about lower real yield, higher fiscal, and weaker currency. Okay. India, for now, we don't have fiscal space. weaker currency, large portion of pain we have taken. So now policymakers need to work upon bringing the real rates. And which is why, in my view, broadly, in run-up to March, we see yields stable to marginally lower. In line
That is
with the global
6.7?
Yes, 6.6 to 6.7. But next year, which is where the big elephant comes in, which is supply, unless regulators step in and they resolve the supply issue, I think we can move a little bit higher towards 7. But for the full year, our fund house view is more like 6.5 to 6.75 by the end of next calendar year.
Oh, that sounds optimistic. I don't have that much time, but what would your range be?
So I'll skip the 10-year question and tell you three things, right? 1 year AAA PSU bank CD rate is at 7%, 5-year SDL, which is a sovereign instrument, rate at 7%, 30-year government bond is at 7.5%. These are absolutely high yields for any investor to ignore. So irrespective of which product you come into, how you enter into bond markets is immaterial. You have to have some reasonable allocation to the markets at this point in time.
Oh, well said. Your range anyways?
Yeah, I would say 670 to 7, because we haven't really addressed where the demand comes in. But I completely agree with what Amit said. Whatever be the level, the absolute levels where we are, and possibly over the next couple of months, given this mismatch, you will get very attractive investment levels, and including real returns, right? I mean, that's equally important.
Fair point. Thank you very much, gentlemen, for a most engaging session, both on the here and now of the bond market and where we are probably headed, where investors ought to head when they do their asset allocation. That's it on this edition of Bond Street. Thanks very much for watching.
CNBC TV 18 and India Bonds presents Bond Street.
Fixed returns do not constitute guaranteed or assured returns. Investments in corporate debt securities, municipal debt securities, securitized debt instruments are subject to credit risks, market risks and default risks including delay and or default in payment. Read all the offer related documents carefully.